Cycle. Joining us here at Post 9, Alexandra Wilson-Elizondo, Deputy CIO of Multi-Asset Solutions at Goldman Sachs Wealth Management. Alexandra, great to have you with us. I like this line from the notes that we got, normalization is not nirvana. So it's not going to be a smooth path ahead. Even though we're seeing lots of Wall Street strategists raise their price targets going into year end. You say caution here.
Yeah, absolutely. I think the most important takeaway from us from the Fed last week was that this is still going to be a long slug. And when we look at how they talked about the market, how they talked about rates, yes, they were more dovish, and they were very focused on patience and incoming data, for example, the data we saw this morning. But at the end of the day, they really honed in that disinflation narrative, saying the biggest risk to us is actually not getting this right. And so we do think we're going to be higher for longer, and that higher interest rates ultimately will continue to put pressure on corporates and the consumer.
Right. What level, in your view, is concerning? Because it seems like 4%, there's a reflexive action in the stock market when we hit 4%. But ultimately, we've been in 4% environments in the past, and stocks have, in fact, gone higher. So what is concern to you in terms of levels?
In terms of levels, 4% is actually attractive to us in the rate market. And that's why we've started to extend down in duration, albeit very thoughtful and cautiously, because we're a little bit concerned about yield curve control and the BOJ infecting global duration. So we're slowly stepping into that. But if you are a believer that ultimately we will see a mild recession, then duration will provide a really important ballast to your portfolio allocation.
Private credit continues to be attractive. Why?
So when we look at the loan market, the public loan market, 60% of it's private anyway. You can actually move into private credit and get better terms, and you have a lot less what we call lender violence, meaning when you go through bankruptcy in the public market, everyone's trying to say, I have a better pool of capital, but you don't have that in the private markets. And so we're seeing double-digit returns that you can achieve. You can step in, be that provider in crisis, be that lender of liquidity that we saw earlier with the regional banking drama. And we think that that's really attractive to the portfolio right now.
What does your overall portfolio look like then?
So from an outright beta or market exposure perspective, we're actually pretty neutral. We spent, the better part of the first and second quarter buying into stocks, and a huge portion of that thesis was that the market was so underinvested, just given where the strength of the consumer and GDP was. That's a little bit less so now. And so we're being very thoughtful into Jackson Hole, looking at where vol is. And if you can trade options, buying some protection on the portfolio. But there's more opportunity from our perspective across the globe, given valuations. Right now in the U.S., you've got multiples in, the 90th percentile. Whereas if you look at Brazil or you look at Japan, you're seeing much better valuations. So we're rotating the book a little bit in order to get some more international exposures.